Good morning, students. My name is C. Divas Gupta, and today we will be covering the topic of derivatives. So, students, initially to start with this topic, we will just run through what are the concepts. We will do the building blocks on the basic concepts, and then we will move to the questions. Assignments are already uploaded, so I request all of you to please download and keep it handy. So let us start with the conceptual building first. So derivatives are such financial instruments. First of all, let us start with what is a derivative. Okay. So for example, this A is a financial instrument. It's just a financial instrument whose value is dependent on or it is derived from B, which is a separate instrument called underlying. So A is a financial instrument whose value is dependent or is derived from B, which is the underlying. Now let's elaborate these terms in detail. And in this entire arrangement, A is called as derivative because A is deriving the value from B. A don't have its own independent value. Whatever movements are happening in A that are governed by the underlying movements, which is B's movement. Okay. Now let us try to figure out that what are the different types of examples. Now let us first take B in detail, which is a underlying. Now, what all types of underlying can be there? Now, so the most common example is equity. Any equity share of a company can act as an underlying. On that equity, we can make a financial instrument which will derive the value from that equity. Okay. So equity, let's say of X Limited or Y Limited. This will be the first underlying, right? Second type of underlying can be the indexes. What is an index? Index is a market index, correct? For example, BSE, NSE, which are indicating how the market is moving, because equity is for one company, index is for the entire market or all the companies put together. So this can be, let's say, BSE, NSE. Now imagine a financial instrument which is deriving its value from how the index moves. For example, BSE moves or how NSE moves. Correct? On BSE and NSE, we have indexes, right? BSE is Sensex and NSE is Nifty. So here we are not talking about what is the financial instrument here. Financial instrument is not the index. The derivative is not the index. The financial instrument or the derivative, which is A, is a financial instrument which is deriving the value from index. Now, for example, Sensex goes up, correct? Then the derivative's value will also go up. If Sensex goes down, the derivative value will also go down. And there will be some relation between both of them. So we will study in detail what type of financial instruments or what we call these as derivatives are. So I'm putting here as derivatives because these are the derivatives that are there. Good morning, Naveen. Good morning, Jitendra. B is an underlying. In underlying, we studied that underlying can take form of either equity or index, or I would like to invite now suggestions from all of you. What can be an underlying? Now just imagine, or you would have heard in the daily life, that what are the other types of underlying on which derivatives can be derived. Okay, Namita, let me check with the team again. What can be other types are Forex? For example, USD slash GBP slash any other Forex. Now imagine that we are in India, right? And since we are in India, our primary currency to transact is INR, but there is a USD that is purchased and sold, correct? All the importers and exporters are buying and selling USDs. Now, those USDs are as good as any trading security like equity, correct? On that also, there is a derivative, or on that also, there is a financial instrument which will derive its value from what is happening in the USD market. Vivrani, good morning. Naveen is saying share metals. Okay, Naveen, that's a good attempt. Namita is saying weather gold M6. Very good. So in this Forex, we are saying that even the Forex movements of USDs or GBPs or any other Forex, there can be a financial instrument which can derive the value from that Forex. Correct? And fourth point, as all of you rightly said, it's commodity. Commodity, what do we mean by commodity? Sugar, oil, metals, all these things. So any kind of commodity. So Jitendra is saying mutual fund can be underlying. Yes, Jitendra. It can be equity, index, mutual fund, bond, anything. Correct, Jitendra? So commodity is another type of. See, what I'm trying to say is that in this, your all the typical financial instruments that you can think of can be a derivatives in terms of underlying. This is something new, Forex, and this is something also new. Now, some of you might be wondering, how come sugar be an underlying? How come oil be an underlying? So, students, if you see sugar and oil also are governed by the market forces in terms of the pricing. Now, their prices can also go up and down, and hence there is a financial instrument that can be created on those prices, on those sugar or oil, which will derive its value from the on in market prices of the sugar and oil. Okay, students. So these are the broad four kinds of underlyings that can be there: equity, index, forex, and commodity. It can be equity, it can be index, any kind of index, it can be forex, it can be commodity. So derivatives can have underlying as any one of them. Now, till now, we have only elaborated underlying. We have only spoken on underlying, correct? What is an underlying? So, as we said that for a derivative to be there has to be a financial instrument in the form of A. There has to be a financial instrument in the form of A whose value is dependent on an underlying, which is B. Underlying we have understood. Now let us try to see what are the features of A, which is the derivative itself. Features of derivatives. Why I'm saying derivatives here is because these are the common features all across the derivatives, whether it is a forwards, whether it is a futures, whether it is a option. Okay, we will cover one by one all these things, but let us first try to see that what are those common principles or common features that all the derivatives possess. So Namita is saying, so debentures cannot be underlying as its prices. Debentures can be underlying, Namita, because debentures or bonds are also traded in the market basis their value. and their prices will go up and down. So anything can be an underlying. Okay, even weather can also be an underlying, Namita, as you rightly said. So hence there is no harm in debentures being an underlying. Okay. So features of derivatives. Now, what are the features of derivatives? See, first of all, for a derivative, now we are only talking from the point of A instrument that we have taken in our example. Let's forget everything about B. B is already covered. Now, let us put our all attention on A. Now, what are the features of A? A will always have a buyer and seller. Okay. This is a very common thing. For a financial instrument to be there has to be a buyer and there has to be a seller. Correct? There has to be a buyer and there has to be a seller. So buyer will buy the financial instrument. Okay. Just keep on noting or registering these terms in your mind. What I'm trying to say is that buyer will buy the financial instrument and seller will sell the financial instrument. Okay. This point we will touch upon again once we will study the forwards and futures. Okay. But we have to remember that here, buyer is not buying the equity share. Seller is not selling the equity share because that is an underlying. What buyer is buying is A. Seller is selling is A. Because there can be separate buyer and seller for the underlying, which is this equity. There can be separate buyer or seller for the equity. But for buyer and seller of A, also will be there as a feature of derivative. Yes, Namita, it can fluctuate. The debentures also can fluctuate if those are traded. Okay, because you would have studied in bond valuation. This is the interest rates, yield to maturity. All those things will impact the prices. So, students, what I'm trying to say here is that we are talking about there is a separate set of buyer and seller of A, and there is a separate set of buyer and seller of B. For example, buyer is Mr. X, seller is Miss Y. This is for instrument A. Similarly, the B, which is underlying, here the buyer will be some other person, which is Mr. S, and seller will be Miss D. Okay. What I'm trying to say is that buyer and seller is very much different from the buyer and seller of underlying. Namita is asking, sir, what is the meaning of FI here? Financial instruments. Okay. So, Namita, that is what we are covering now. First, we will cover that what are the features of financial instrument. Then we will try to jump on a conclusion. What is financial instrument? Okay. But the definition is more or less same that you will study or you would have already studied in your paper number 1, the financial instruments, where we do the accounting of it, the reporting of it. Okay, so this is my first point. The buyer and seller are pretty much separate. There has to be a buyer and seller of a derivative. Then only the derivative will come into existence. If there is no buyer and seller, or if there is only buyer, there is no seller, no derivative can come into existence. Okay. Now, second point. This we have already studied that value of a derivative is dependent on the value of underlying. This is the most critical point, and because of this only, it becomes a derivative because it derives its value from the underlying. This is also one of the feature that is common across all the derivatives. Okay, this is true for all the derivatives, any derivative you pick. Then next point. There is a expiry element to most of the derivatives. Okay, not all the derivatives, but to most of the derivatives, there is a expiry element. That means derivative which is a financial instrument. Okay, now let me elaborate it further. Now, students, keep on noting these points. Derivative, which is a instrument, correct? It is nothing but a financial instrument. And financial instrument is in the form of a contract, correct? It is a contract, and contract have a expiry. They have a validity. All the contracts have a validity. Okay, all the contracts have a validity, which is expiry. So, for example, 3 months, 2 months, 1 month, 1 year, 6 months, can be anything. That is why the basis is this contract. Through this contract, a financial instrument is born. That financial instrument is called as derivative. And in that contract, we will mention that there is a specific expiry. So there is a expiry of the financial instruments. Expiry of A, we are saying, which is a derivative. Then fourth point, since there is a expiry, what will happen after expiry? After expiry, settlement will happen. Settlement will happen. So these are some of the common features I'm saying for derivative instrument. So once, let's say, the expiry was for 0 to 3 months, after this 3 months, there will be some kind of settlement that will happen depending on what what the buyer and seller have contracted. That contract will be is already in execution for these 3 months, and finally the settlement will happen basis the contract. Okay, now what can be that settlement? That settlement can be that either buyer will pay to the seller or seller will pay to the buyer. Simple. There will be some cash outflow or cash inflow either at buyer or seller's end. That is called a settlement. So the in technical term we call it as payoffs. Payoffs for buyer and seller. There will be different kind of payoffs for a buyer and seller depending on what the situation is. But what I'm trying to say here is there will be a settlement. Now, if there is a buyer and seller who is different from the underlying, or they can be same also, but there has to be a buyer and seller, and that financial instrument for which there is a buyer and seller, its value is derived from an underlying. Since it is a contract, that financial instrument, there has to be expiry of that contract. After expiry, there has to be a settlement. That means the payoffs. Because once the contract is over, whosoever gains will receive the money. Whosoever loses will pay the money. Once the settlement is also happened, so these are the four broad features. And then now let's talk about the terms and conditions in that contract, correct? Which is A. While I will use the word contract here, it would mean that it is a financial instrument or we are talking about the derivative itself. So the fifth point is that in the contract, there will be certain items that will be certain. Certain means that are fixed or that are specified. Fixed slash specified. And there will be some other elements that are uncertain. Which is a variable in nature. Now imagine a contract. In this kind of a contract, what can be a fixed or a specific thing or a specific element into that contract? See, first of all, they will fix in the contract that what is the underlying, correct? They cannot change the underlying in the contract. The buyer and seller cannot enter into a contract where they don't know what is the underlying. They have to mention that specifically in the contract. Then only the terms and conditions will be very clear. So what I'm trying to say is that one thing is certain, which is underlying. Underlying is very much certain, correct? Underlying asset, I mean to say here. What is the underlying means? Underlying asset is certain. Second thing is quality of the underlying asset is also certain. Now, students, if you note, where does it matter? If we talk about commodity, there is a sugar, there is a oil, correct? There are different grades of oil, different grades of sugar. They will also specify that they want uh, crude oil, for example, or they want petrol, whichever grade, or they want grade A sugar, grade B sugar, like that. So even the quality will also be certain, because then only they will be able to specifically enter into a contract, correct? So the quality of underlying asset is also certain. Then quantity of an underlying asset is also certain. They will enter into a contract of 1000 kgs, 1 ton, 2 ton, 3 ton, anything. So the quantity is also certain. And last thing, the time period or expiry is also certain. Correct, students? So these all items are certain in that particular contract. Because while entering the contract, they need to know that what is the underlying asset, what is the quality of that underlying asset, how much quantity are we going to enter into, and what is the time or expiry of this particular contract. These all things will be certain, fixed, specified. Now, can anyone tell me what things will be uncertain? What all things will fall into the uncertain category? Just think and let me know. Or I can say that what is one thing which is variable? We have already discussed about it. Students, please do respond so that I can come to know that whether you are able to understand or not. So what is that one thing which is uncertain or which is a variable in this entire contract between A and B? A is our derivative. For a derivative, what is the only thing left which is uncertain? Then we will go to our next topic. Value, price. Right. Jitendra, you are right. Harshad, you are right. Naveen, you are right. Thanks for answering. It's price. Price of the financial instrument is uncertain. That's the biggest uncertainty in the derivative, because it is dependent on the underlying asset, and you never know tomorrow where that underlying asset is going to be. Now, Namita is asking, sir, what is the objective of commodity derivative? Why it is introduced in market? Very good, Namita. Now I am covering commodity derivative only first. Okay. Now you just see from that example how commodity derivatives are useful. Now these are the six, I would say six, 5 and 6. So there are the 6 features. Very good. Namita is also saying prices of underlying. Naveen Prakash is also saying of underlying. Perfect. Good. So what I'm saying is these are the 6 common features of a derivative, which is A. Now we have sufficient supporting knowledge. What is A? Correct. We can understand that A is something which is a contract, which is in the form of a financial instrument, and hence there are two parties involved, buyer and seller. The valuation is dependent. There is a fixed expiry, and after that there is a settlement. And in the entire contract, there are certain elements that are certain. There are certain elements which are uncertain. Now let's come to the types of derivatives. Now let us try to understand the specific financial instruments now. Okay. Till now, our discussion was very generic. Now we will come specific to the discussion. One, so the types of derivative, the first derivative is forwards that we are going to study now. Now, with this background knowledge, it will be very easy for you to correlate and understand this. Now, students, see what is a forward. Okay, let me say that this is a forwards contract. Okay, contract we have already understood. Why we are putting a name of contract? Because all the derivatives are contract only. The financial instrument is born from that contract, correct? Now, assume that you are a procurement manager. Of a very big company. Okay, let's say you are a procurement manager of a very big company and you are entrusted with the task to purchase crude oil, because crude oil is required in the items that the company manufactures. So your task is, from amongst other things, is to purchase crude oil, because crude oil you need, and crude oil also you need grade A. There will be, let's say, different types of crude oil, grade A, grade B, grade C. Now you are interested for a task to purchase crude oil of grade A. But the condition here is that you don't need that crude oil today, because as on today, you have sufficient quantities with you. You need this crude oil after 6 months, because as per the forecast, till 6 months, you have sufficient stocks, basis which your production can happen. And hence, as a procurement manager, you don't need to buy anything up to 6 months. The point is, you need it after 6 months. Required delivery of crude oil grade A after 6 months. This is a very practical example. Practically, it is very much possible. Now, what will you do? You will not be able to purchase and keep it now, because then the inventory will be high and there is no requirement also. There is no point in purchasing and keeping it. Since crude oil is a highly volatile commodity, okay, it's highly volatile. The price today, you never know where it is going to be tomorrow. Just in one day, you can see a lot of blips in the prices. And since you are a procurement manager, you are a subject matter expert of that crude oil, you know that the crude oil behaves as a very separate animal. We don't know where the prices is going to be. Now, how can I protect the company's profitability, right? Because today I know that today the price is rupees 100. For example, it is going on. And basis some workings, basis some correlation, basis some anything, I am able to derive that after 6 months, basis some trend analysis, forecast, previous pricing, seasonality, all these things, I am able to forecast that after 6 months, the price that I'm going to get is, let's say, 120, for example. Correct? Now, you are in a deep trouble, because today you are getting at 100. You know that there is certainty of what? Quality, underlying asset, correct? Expiry. These are all certain elements. And also, let me introduce here that you need to purchase crude oil grade A 20 liters. So the quantity is also certain. What all things are certain to you as of now? You know that you have to purchase crude oil, which is underlying asset, grade A, which is the quality, quantity is 20 liters, and for after 6 months, you need the delivery. That means the expiry would be 6 months, correct? But this price is just an estimation. This 120 rupees is just an estimation. It's just an estimation from your end. It can be 120, it can be 110, it can be 130, it can be anything. Now, but one clear thing that you have in your mind is, as a procurement manager, that definitely after 6 months, I don't know whether the price is going to be, but definitely it is going to be on a higher side. because never the prices have gone down of crude oil. It is slowly going up only. So that means you have sufficient information to believe that prices will go up. Now, how are you going to protect the company? Because you have a target as a procurement manager to control your purchase cost, correct? Now, what will happen? See what kind of deal this procurement manager goes and do in the open market. So first of all, it approaches one of the supplier. Now see, just a second. Here the procurement manager is there. Here the supplier is there. Both of them are sitting over a table. Over a table. Now what procurement manager says is, see, I have to purchase crude oil from you after, but not today, after 6 months. And I need grade A 20 liters of crude oil after 6 months. These things are certain. The only thing which is uncertain is price. Let us make it certain that as well today. Let us decide that price and lock it. Now supplier says that after 6 months the prices are going to be high. That is what I also know. How can I enter into a contract with you at the current price of 100? Because according to my calculation, it can go up than 100. So then purchase manager or the procurement manager says that, okay, let us do one thing. Let us negotiate and arrive at a price that will be applicable 6 months from now. That is not applicable as on today. That will be applicable as after 6 months from now. And that price will be certainly derived from the today's price. Correct? This is the today's crude oil price. So what this purchase manager says and supplier, they finally both agree and negotiate a rate of 110. So purchase manager says that, okay, let us lock the rate of 110 to supplier, and supplier says that, okay, I will deliver to you after 6 months. Deliver after 6 months. Perfect. Now what both of them have done after this? This is a contract that they have entered. What does the contract says? Contract says that the price will be locked at 110 for the delivery of crude oil A grade 20 liters after 6 months to be delivered from supplier to the company of the procurement manager. Okay. Now what has happened is this entire arrangement is called as forwards. This is a forward contract. And it is a derivative. Why? Because from where this 110 is derived, this is derived basis the current value, the current spot price of that particular underlying. Now, students, let's see what happens after 6 months. Let's say this is a story as on today. Now, what will happen after 6 months? That will clear a lot of things in your mind. Let us talk about a simple scenario. This is the price after 6 months, and this is the negotiated price I'm putting here. Negotiated price. Okay. Let's say case one, let us take. Here your procurement manager is there, and here the supplier is there. We will try to see what impacts does it creates to both of them. Negotiated price was how much? 110. Correct? That is the price at which they have logged. Now let's say after 6 months, the price of this crude oil grade A comes as 115. After 6 months, I'm saying actually. So what is going to happen? Okay, before this, let us go here and see what would be the settlement that will happen between both of them. Procurement manager, supplier. This is after 6 months. Okay. Let us first see the settlement between both of them. So what will happen here is procurement manager will pay to the supplier 20 liters multiplied by 110 because that is what the contracted rate is. Okay. So it will pay 20 liters into 110 to the supplier. So this comes as 2200. Supplier will deliver 20 liters of oil, delivers 20 liters of crude oil to procurement manager. Simple. Very simple, very straightaway transaction forward settlement. This is settlement. This is only from the contract's point of view that they are able to settle this transaction because they have entered into the settlement. Namita is asking how much are the chances that supplier will not default in such type of contracts? Yes, Namita, these are definitely highly risky contracts because you never know that where the situation is going to be. Hence, these are always secured by contract. These are legally enforceable contracts. If there is a default, you can go in a court of law and enforce these contracts for the other person to perform its obligation. Okay. So we cannot say that there are chances of default. There are no chances of default. But what we can say is yes, since the structure is such a manner that we never know what is the outcome is going to be. Hence, these contracts are very risky contracts. Okay. So the settlement from the contract point of view is over here. Now, what I'm trying to explain here is the position of the individual person. If the change, if the spot price after 6 months changes the negotiated price. Okay. Now, what is, for example, 115 is the price after 6 months and negotiated price is 110. So the procurement manager of the company will be very happy. Why? Because he will say that it's good. I have entered into a contract of 110. If I have not done that, I would have purchased the same crude oil from the market currently 5 rupees costlier. 5 rupees on a higher side, I would have purchased it. So he would say that I have made a 5 rupees of gain. Because here I am able to save 5 rupees for the company. I can say that save would be the right word. Because the opportunity that otherwise I would have is to purchase at 115. Currently, I'm purchasing it at 110. Now, what this supplier will say? Supplier will say that, oh, I would have sold this 20 liters in the open market at a rate of 115. But because of this contract, I have to obey my obligations and hence I have to deliver at 110. There is a loss to me of 5 rupees. Is this clear? The derivatives on the forward settlement. Now let us take case 2. Case 2, let us assume that the price comes as 110 is the negotiated price. 95 comes as the price after 6 months. Now what will happen? Once the price comes as 95 after 6 months, actually, what will the procurement manager say? Procurement manager will not be happy at all because he could have purchased in the open market at the rate of 95. But because of this obligation, because of this contract, he has to still purchase at the rate of 110. So there is a loss of 15 rupees to this procurement manager. Similarly, the supplier, see how supplier is thinking now. If in the open market, the rate is 95, I am able to sell at 110. That means I am gaining 15 rupees extra. Because this 95 rupees is not relevant to me. I can still make my deal and I can still deliver it at 110. Now, Namita, to answer your question, in case 1, supplier, there are chances that supplier will default. In case 2, there are chances that this procurement manager will default. Procurement manager will say, no, I am not. What is this contract you're talking about? I am not bothered about this contract. Let's forget this. Then supplier will come and say, no, we have entered into a contract. I will execute. I will otherwise take you to the court. I will execute this contract if you're not performing your obligation. Correct? Procurement manager say, okay, what in the initially I have not paid you anything, correct? It's just a contract. Initially, while entering the contract day one, have I paid anything to you? No. I can still come out very easily out of this contract in case two. The procurement manager will think, but supplier will not let him do that. Correct. So that's the kind of practical things will happen, but they will have to honor their contracts. If they are not, then these are legally enforceable. Correct. So I'm saying the actual situation can turn out to be any of the ways, whether case one or case two. And case 3 can also be there, which is nothing but if the prices are same. These are the only 3 cases possible. No loss, no gain. Because in the open market also the price is 110. The negotiated price is also 110. So there is no further requirement on anything on this from both the ends. Okay, students, I hope this concept of forwards is very clear to all of you. Please do ask any question that you have in your mind so that we are going ahead from a doubt-free mind. Any question, any doubt in the entire things that we have covered till now? So can I say that forwards is a over-the-counter contract? It is very much customized. Over-the-counter means, see, both of them, I used the word, both of them are sitting over the table, right? While I was drawing this, procurement manager and supplier, both of them are sitting over the table. So that means this deal is happening over the counter, correct? Over the counter means that it is highly customized to suit buyer and seller both. Both of them will benefit out of it in terms of their customization. Okay, these are not standard contracts. These are over-the-counter customized contracts, OTC contracts. Okay, because if they want in this, instead of crude oil grade A, they can put grade B. Instead of 20 liters, they can put 21 liters, 22 liters, whatever they want. Now let us come to futures. We will go to the questions for the better understanding, but as of now, let us first try to understand what are the concepts. Okay. So the first derivative was forwards contract. Second is futures. This is the second. Thank you, Naveen. Jitendra is saying value is derived point-to-point basis from the underlying assets of FI. Yes, Jitendra. Now we will be covering that concept. Value is derived from point to point. That is true for futures. Okay, Jitendra. Because forwards is one time before you will enter the contract. At that point of time, you will see the underlying and fix a value, and then you will move forward. But futures, on the other hand, will come with what you are saying, Jitendra. Okay. Now, what are futures? Futures are same as that to forward. Okay. Then what is the need of future? Except. So, same as that to forward contract, except. What is this except now? First point. These are standard contracts. As I told you, forwards are over the counter, correct? Forwards are over the counter. These are very customized. But on the other hand, futures are standard contracts. Standard means it will say that one contract is for 5 liters of crude oil. If you have to purchase 20 liters of crude oil, then you enter into 4 such type of contracts. Because the contract is standard, it is traded in the market. For all the buyers and all the sellers, the quantity will always be 5 liters. If I am a procurement manager and I have a requirement to purchase 20 liters, I will purchase 4 such contracts because these are standard contracts. I cannot modify. I cannot modify anything. I cannot modify quality. I cannot modify quantity. I cannot modify underlying asset. I cannot modify even the expiry also. Expiry also is standard. Okay. Standard means consistent for all the buyers and sellers. Second thing, in this, the settlement on net basis. No actual delivery. Actual delivery or yeah, that's all. No actual delivery. I'll elaborate this point now. So students, if you see here, how does the settlement happen? The settlement has happened that procurement manager has paid to the supplier this 2200 rupees and supplier has delivered 20 liters of oil. This is the settlement that has happened in forwards contract, but this is how the settlement will happen in the futures contract. So this after 6 months, the table that I've put here is nothing but the settlement of a futures contract. So see how in the market they will think the futures price was 110 at the time when they entered 6 months back. After 6 months, the futures price comes as 115. The buyer of the futures will save, the seller will lose. Similarly, if it comes out to 95, the buyer will lose and the seller will gain. Sorry. Okay, students. So this is what is going to happen on the future settlement. We will cover enough questions to understand this in detail. Namita is asking, sir, what is the objective of equity derivative introduced in market? Namita, we will cover that. What are the uses of this derivatives? What will be an outcome of using a derivative? That we will cover. Okay. Let us first try to understand that what are the different types of derivatives. Now, in this, what I'm saying is for future, the settlement will happen on net basis. Whosoever loses will pay only the net amount. Whosoever gains will realize only the net amount. Okay. It is not that entire contract will get executed, unlike in this is the settlement of a forward contract. And the settlement of futures is on net basis, correct? So the net payoffs will be calculated. Okay. And third thing is that since these futures are standard contracts and settled on a net basis, so these are traded on stock exchanges. So these futures will trade on stock exchanges, not forwards. Forwards are only over the counter meant for one particular buyer and one particular seller. But these futures are meant for a lot of buyers and lot of sellers. So these are standard contracts. These can be traded over a stock exchange. Now let us see an example first. So for example, this is a stock exchange. Okay. Now here is X and here is Y. So X places a request to buy. Places a request to buy futures. I hope you understand what do you mean by buying and selling here. I'll just take you through what is the exact meaning there. And here it will place a request to sell. Place request of selling. What? Selling what? Selling a future, not the equity share, but we are talking about selling and buying of futures. Futures is also a separate financial instrument here, correct? We are not talking about here purchase or sale of a equity. We are talking about purchase or sale of a future. Now, okay, now comes the very practical part also. This is how it happens. Okay, let me put it like this. There can only be there can be only two scenarios with which the information I possess in market. For example, I am a regular trader on a stock exchange. I trade a lot. I know that, first of all, I'm not talking about anything on derivatives or spot market, correct? I'm just talking purely on the principle. For example, if I have information that price goes up in time to come, in some time to come, the price is going up for a particular security, which is security, or let's say X limited equity share, which is traded in the market. So what I will do, since I know that this information is coming from a very good source, I will buy the security X limited. I will buy it, and since the information was very true, once the price goes up, I will sell it. That means I can make a profit if I have an information that the price is going to up. Okay. Now, this is a very easy and very simple scenario. That's how what we also do. There is nothing new in this, correct? Now, the new part for a lot of us will be, what if we have an information that price goes down in time to come? Now, how I am going to react here? Again, the same security. As of now, I am not holding any shares here because this information is coming to me. I am not holding anything, because if I am holding, then it is very easy for me, correct? But that's how a trader does, right? Trader will not hold. Trader will just take an advantage of these price sensitive informations. Now he knows that because of some XYZ reason, price in the time to come is going to go down. Is there a way, students, I can make a profit here also? If yes, then please help me with all your thoughts on the question handle. Just think through out of the box here that in case the price is going up, I am purchasing and I'm selling. Purchasing at a lower cost, selling at a higher cost. If the price is going to go down, is there a way I can still make a profit out of this? And how? Please do attempt this question because this is very interesting. Okay, so Namita is asking, sir, if forwards are there, then what is the need due to which futures introduced? So Namita, that's what the difference that we have studied is itself self-explanatory. Since these are standard contracts, now what will happen is a lot of people would not have time to enter into a contract as a forward contract, correct? Because people like me, people like you will not essentially want anything in terms of a delivery, but still we want to take benefit of the price movements, correct? So hence, we will not enter into a forward contract because who will fall into into a lot of efforts to perform a contract, to make a contract, to validate it, to make sure that all things are happening. Better to go to a stock exchange where all these contracts are already standardly, being traded, and hence let's do the trading there. Okay. So Naveen have attempted this very well. Naveen is saying sell futures. Okay. Very good, Naveen. I think you have clearly thought what I'm trying to make you understand. So students, come back here. What I'm saying is, as of now, I'm not Naveen going to the futures as of now. I'm saying in the regular market only. Uh, Here I don't want to explain the difference between futures or a security. What I'm trying to say is that if there is a information that I possess that the price is going to go down, I will sell security of X Limited today and purchase it afterwards. Now, for example, today the price is how much? 200. There is a information that the price will go down. Let's say it goes down to 150. Now, what is the profit out of it? The profit is 50 rupees because I have sold at 200, purchased at 150. The net profit is 50. Now, many of you would be wondering, how can I sell what I don't have? How can I sell what we don't have? Correct. Because I'm telling you to sell here first and chase. How can that happen? Okay. If that is the case, then what are the guardrails to it? Selling first and buying first. This is called as, first of all, as a concept, this is called as short selling. Okay. Short selling means we are selling short what we don't have, and then we will purchase it. Now let's talk about the spot market, which is a cash market, and second one is the derivative market. See students, there are these two markets that are operating on any stock exchange. Okay. If you go and see practically also, so there is a different segment of derivatives and there is a different segment of spot or cash market. What is the spot or cash market? Where actually the equity shares are traded. Equity shares are traded. Here the futures and options are traded. So as of now, I'm only taking futures. Options we will cover later. So in the derivatives market, futures are traded. And these futures are futures on the equity shares. So these are two different types of market. So the first case that we discussed here, this is case 1 and this is case 2. The first case that we discussed here, that if the price goes up, this one, if the price goes up, then you can buy and you can sell. So this is very easily done in both the markets. Case 1 is okay. Case 1 is okay in both the markets. Now, if you have a information that price will go up, what you can do is you can either buy the equity share in the spot market or you can buy a future in the derivatives market. Okay. But case 2, which is short selling, is only allowed intraday here. Intraday, which means within one day. Within one day, you will have to we will have to sell and purchase. You will have to sell first at 200 and you will have to purchase at 150 within one day. That is called as intraday. Within one day. That is the only thing legally allowed as of now in spot market. And for case 2 here, which is short selling, so this is allowed, this is allowed. Now I am talking about case 2, right? So case 2 in derivatives market is allowed intraday also. This is the beauty of futures market. And I'll tell you the reason also. See, spot market or cash segment, which is the in which the exact underlying is traded, in that the short selling is only allowed within one day. Within one day, you have to square up your position. If you have sold, you will have to buy. Correct? But in case of futures, if you have sold it, if you have sold the futures also, then also within the same day, there is no necessity for you to buy it. You can carry forward that position and you can buy it later on. This is where the derivatives market plays a bigger role. Now I'll tell you why also. Let me first take the question of Namita. Namita is asking, sir, if we are able to sell at 200, this means prices are at 200 level in the market. That's correct. So how are we able to purchase at 150? Okay, Namita, this is what I was trying to build a situation in case two, that you have a information that price will go down in the time to come. And currently it is at 200, but after 1 day, after 2 day, after 3 day, or after some point of time, in time to come, the price will go down to 150, which has come also 150 here. So the security of X Limited, we can purchase back at 150 then whenever it comes. So we will purchase at a lower price, sell at a higher price. The profit can be booked. Okay, Namita. Now, referring to this part of the discussion, short selling in spot market is allowed only for 1 day. Within 1 day, you have to purchase and sell. Sell and purchase, sorry. Okay. And in derivatives market, it is allowed intraday also. Now, what is the reason behind it? If you see in spot market, how spot market behaves. Spot market, if you are selling today, if you are selling first, correct? Then if within the same day you are not able to take square up the position, so what will happen is you will have to settle. Now the settlement in spot market will happen on the actual delivery, correct? If I'm selling, so that means I have to actual deliver X Limited shares, correct? But since you don't have purchased it within the same day, then how are you going to deliver it? And hence there is high chances of default from the seller end. And hence this law came that within the same day only you have to square up. Selling first, then you have to purchase also within the same day. So that within for 1 day the settlement will happen at once. You will purchase and you will sell. That's the story is over. Okay. So that means the actual deliveries can happen now, because the actual delivery will happen basis the purchase, and then this would be sold within same day, correct? And why I'm saying within same day, because all the settlement of same day will happen at one point basically, and hence there will be no issue in this. But in case of a derivative market, if I'm selling futures first, sell futures, then am I required to, at the time of settlement, which is happening after the day end, am I required to deliver the stocks? No, because I have only sold the futures. I have not sold the stocks. I have not sold the equities. I have only sold the futures. And in futures, what we said is the settlement will happen on net basis, not on actual delivery. Unlike forwards, the settlement is happening on actual delivery, right? So here is the utility of this futures, that you can sell it, and after 1 month, once the price goes down, you can again purchase futures, and still you can book a profit which you are not able to book in spot market. This is the utility of futures, and this is what futures is, because futures are also traded in the stock market. I hope the concept of short selling, spot market, derivative market is all clear to you. Intraday, interday is all clear to you. If you have any questions, I'm happy to answer. Namita is asking, sir, in the spot market, uh, Namita, please complete your question. I think only half of your question has come. Okay, students. Now, we have studied three things till now. One is cash segment or spot market. Spot market means that today's price, whatever is happening as per the proper. So this is for the underlying. So in which underlying itself is getting traded. That is called as cash segment spot market. Then we studied forwards. Then we studied futures. Futures are standard contracts traded on stock exchange. Forwards are over the counter contracts, customized contracts. Then forwards needs to be settled on actual basis. Actual basis means the 100% settlement has to be there. The delivery will be there. The entire payment will be there. Correct. And this will be settled on net basis. This is basis the payoffs that we have calculated. Okay, students. I hope this difference is clear to all of you, because this is very important for us to move ahead in the next part of the session. Namita is asking, sir, if in spot market, if settlement happens after 2 to 3 days, it is possible now that seller will purchase immediately before delivery. No, Namita, I'll tell you. I think this is what you're trying to ask is, in spot market, T+2 settlement happens. So on the day of transaction, the settlement will happen on the second day or on the third day, correct? What I'm trying to say is that, but the settlement will happen for all the transactions that are happening on T day. Although it is happening on T plus second day, correct? But it is not that the first day transaction will also be taken, second day transaction will also be taken, and then all 3 days transaction put together will be settled. No. The settlement will happen on second day, but it will happen for all the transactions on the T day, which is the transaction day. Okay. So hence, within the same day, you have to purchase it back. Okay, Namita, I hope this is what you are trying to ask. I have not complicated it with T+2, T+3, because I want to cover the logic here. Thank you, Naveen. Okay, now let's come back to the business now. I was on this chart, then we went to study the short selling. Now what I'm saying is, let us come back to the futures now. Okay, how does futures behave? Now for futures also, there is a buyer, there is a seller. Buyer of future means that they are placing a request to buy the future. And seller of future means that they are placing the request to sell the future. Now what is a future is? Future is that it is a contract on the underlying, correct? Now buyer means he is agreeing to buy the stock after maturity. Selling the future means that Y is agreeing to sell the stock after expiry, correct? That's how it is happening. Buying the future means that X is agreeing to buy the stock after the expiry. Selling the future means is Y is agreeing to sell the stock after expiry, correct? But they are entering today in the form of futures. So for example, there are different types of expiries that are available in the market. Now I'm talking purely on the market front. Always, if you see, there are 3 futures that are being traded. 1 month expiry, 2 months expiry, 3 months expiry. There are 3 types of futures. And all of them will expire on last Thursday of the month. That's how it happens. Last Thursday of the month will be the expiry. For example, we are talking about A Limited's equity share. A Limited's equity share is traded separately in the spot market, and the future on A Limited's equity share will be traded in the derivatives market. Now there will be 3 futures at any given point of time, One is having a 1 month expiry, 2 month, and 3 month expiry. And all of them will expire on the last Thursday of that particular month. Now, for example, between X and Y, they have done a deal. So they have done a deal here. Now, what is the deal? Deal done. Deal is done that X and Y purchases this at what price? Let's say 110. Again, I'm taking the same example. Instead of X and Y going there for the crude oil, correct? Now I'm taking the same example here. Deal done at 110. So 110 is the price at which the futures are purchased by X and sold by Y. Now let us try to see the net payoffs on settlement. How the payoffs will happen. Again, let us put the price here. Let us put the future price. So basically, this is the initial price at which we have purchased or sold the future. Okay, just a second. Let me remove it here and put it here only. Okay, here it is X and here it is Y. X have purchased it, Y have sold it. Okay. So what if on the settlement, correct? Settlement will happen when? Depending on the contract that they have entered. If they have entered 1 month contract, 1 month from now. If they have entered 2 months contract, 2 months from now, like that. So on settlement, let's say the price comes as 115. Okay. The price comes as 115. Now X has agreed to buy the stock at 110. Correct? Because at 110 they have done the deal. Correct? So if it happens at 110, the price is 115 in the open market, X will be very happy, correct? Because X will say, due to this purchasing of futures, I am able to purchase the stock after the expiry at 110. So there is a 5 rupees gain that X will have. And there is a 5 rupees loss that Y will be at. Because what Y will say is, if I have not entered, if I have not sold this future, because what does this future for Y means? Future for Y means that it is a obligation for Y to sell at 110. Correct? It is an obligation for Y to sell at 110. So that is where this 115, that 5 rupees of loss will be there. Because if in open market, Y would have sold at 115 and realized 115. Similarly, if the price is 95 here, so 15 would be the loss here and 15 will be the gain here. Again, the same set of logic here, correct? So these are the net payoffs. Now, what will happen at the time of settlement? In case 1, X will receive from Y 5 rupees. I'm talking about from the exchange point of view. Okay, this is the stock exchange point of view. And case 2, this is case 1. Case 2, X will have to pay to Y 15 rupees. Correct? This is what the net settlement basis the futures will be. Okay, students? So, unlike forwards, the net settlement will happen basis the price, whatever is the differential. Namita is asking, sir, why intraday settlement is required stock market? If settlement happen later, it is possible that seller will purchase immediately before delivery. No, Namita. That's what I'm trying to say. Okay, let me explain it here. Let's say there is day 1, day 2, day 3. Now, on day 1, you sell a stock, correct? What will happen? The settlement of day 1 will happen on day 3. Basis the T plus 2 concept, correct? Transaction plus 2. Now on day 3, what you have to do to the stock exchange? You have to deliver, because you have sold, you have to deliver the stock. But do you have the stock? No. What you are saying, Namita, is that can we purchase it here? If you purchase it here, still you won't be deliver it, because on day 3 the settlement is only happening for day 1, not for any transaction on day 2 or not for any transaction on day 3, because day 2 settlement will happen on day 4. I hope you're getting my point. So hence you cannot purchase it here and square up the position. You will have to purchase here only, so that both the purchase and delivery will happen on day 3 together. I hope, Namita, you're able to get my point now. Point to point linkage in derivative value, we will cover that, Namita. Okay. Now, this is what I was trying to say is that the settlement will happen basis the payoffs that we have just now studied. Okay. Now let us go to the next concept. So something out of this, now let us try to revise our compounding concepts. This is very important for us to understand. Okay. Now, compounding, we know that, let's say there is R is 18% per annum, rate of return is 18% per annum, and we have to do an annual compounding. Very easy, very simple. What we will do is A is equal to P 1 plus R raised to the power T. Now, what is A is future value. P is present value. Correct, students? So this, I think all of you know. There's a very simple formula, and R is annual rate of return. T is time period, which is expressed as 1 is equal to 1 year. Correct? Right, students? So this is the formula for annual compounding. The future value. So annual compounding is what? The future value of a compound. What is that? Is the present value multiplied by 1 plus R raised to the power T. R is the annual rate of return. Correct? So Namita, okay, in intraday settlement for spot market is introduced for the simple reason that if you don't purchase in the same day, okay, see, if you see here where I mentioned is, see, if you, today is what? Today is 3rd December. Okay. Then tomorrow is 4th December. Then there is 5th December. Okay, Namita, now please hear to me very carefully. If you are selling something today, which you don't have, okay, if you are selling something today, which you don't have, then how are you going to deliver it? That is my first question. Correct? Now, what will happen is on 5th, once the settlement of 3rd transaction will happen. See, the 4th December and 5th December transactions are happening independently. All the 1-day transactions are happening independently. Now, if you're selling on 3rd December, and if you don't have that, how are you going to the settlement while you have to deliver the stock? How are you going to deliver the stock? You are not going to deliver the stock. Hence, you will have to purchase the stock. Purchasing should happen only on 3rd is what I'm trying to say, not on 4th and not on 5th, because the 4th purchase will be settled on 6th December. You're getting my point? So on 5th December, the delivery, what are we going to produce? Namita. Okay. So hence, on 6th December, if we are purchasing on 4th, then 6th is what we will get the delivery And how can on 5th we can deliver it? We can't, right? So hence we have to purchase also on 3rd here. So that once on 5th, the delivery is happening on this selling, we can say that we have also purchased it. So the delivery will happen to us and then we will deliver to on the 5th. So net settlement will be 0, right? +1 -1. So stock exchange will say that, okay, net settlement is 0 delivery. 0 I have to deliver you and 0 you have to deliver it to me. That is the reason of introducing intraday settlement. Okay. On short selling, Namita. Okay. Now, anyways, this is actually just to make you understand, because in some of the questions, the language will be like that. Okay. That is the main element. Let's cover the other topics first, and then I will again relate it from the questions. Okay. Once we do it. Now, what I'm saying is on the compounding. Now, all the students, please focus attention here. What is a compounding is R is equal to 18% per annum. If we say, and that has to be annually compounded, the formula is very simple. In this, we will just put A is equal to P 1 plus 18% raised to the power T. T is equal to 1. Correct? Because it is an annual compounded. Now, case 2 is R is equal to 18% per annum again. Correct? But it is semi-annual compounded. R is equal to 18% per annum, but it is semi-annual compounded. That means all the half-year compounding has to happen. Now, what we will observe is A is equal to P 1 plus R raised to the power T. This will remain same. Correct? The formula will remain same. Only one thing that we are going to do here is we are going to add. Okay, now let me derive that thing first. 1 plus 18% divided by 2 we will do, because this 18% is per annum formula, and there, since it is semi-annual compounded, that means in a year it will be compounded twice. It will be compounded twice, correct? One in the first half and second in the second half. So this will give us the annuity value after 1 year. A is equal to after 1 year. This A will be after 1 year. Now, if I can rewrite this formula into some technical formula, so it will say as A is equal to P 1 plus R divided by N, T multiplied by N. This is the formula that we have to remember. Now, in this, let us specify the things. A is equal to future value, P is equal to present value, R is equal to percentage per annum. This is the rate of return percentage per annum. T is equal to time period. This is expressed as 1 is equal to for 1 year. Now, while I'm saying it is 1 for 1 year, if we have to find a future value for 6 months, after 6 months, then T is equal to 0.5. I hope you're able to get my point. Okay. So always remember time period is 1 for 1 year. And hence we can say if it is for 2 years, the T will be 2. Simply. And N is equal to number of times compounding in a year. In 1 year, what is the number of times we are doing a compounding? Okay. Now let us take case 3. Case 3 is R is equal to 10% per annum. Correct? And time we need for 3 years. Correct? And this compounding should be done 4 times a year. I'm just complicating this so that all of you understand the relevance of it. Compounding 4 times per year. Okay. Only refer to this, what I have told you till now. T is equal to time period, R is equal to percentage per annum, N is equal to number of times compounding in a year. Now, R is also given, T is also given. Since T is equal is in T, 1 is 1 year, so 3 will be 3. 3 years will be 3, correct? And compounding is happening 4 times per year. That means every 3 months, the compounding will happen. So that means N is equal to 4. Because what is N? Number of times the compounding in 1 year. Now let us try to see the formula. A is equal to P, 1 plus 10 percentage divided by 4 raised to the power 3 into 4. Very easy and very simple. Now let us validate this formula. So this will be 3 for the 12. So in totality, 12 times the compounding will happen. That's right. And compounding will happen at the rate of 2.5%, which is 10 by 4. So because in 3 years, there will be, in 1 year, if there are 4 quarters, so in 3 years, it will be 12 quarters. And if the rate for the entire year is 10%, the rate for 1 quarter will be 2.5%. I hope I'm able to clear this point. Okay. So just remember this formula and the notations here. So N is equal to number of times compounding in 1 year, time period, and percentage per annum. You will never get confused while applying the formula. Then comes the last step. Okay, so students, now the last thing for compounding is, now what happens in the practical life? In the practical life, the compounding does not happen 3 months, 2 months, 1 month. Compounding does not even happens daily. Compounding happens every second. Okay, every second there is a compounding element that is there. So it is continuously compounding. Continuously compounding. Now, case 4, we will have to treat it separately. There is a continuous compounding. There is no break in compounding. It is not happening after every 3 months, after every month, after every day. No, it is happening every second. Compounding is happening every second. So for this, we have to just remember this very simple and easy formula. A is equal to P R raised to the power T. Simple. There is a derivation of this also, which we will not be covering in the class, because in that there is a use of limit n raised to the n tends to infinity and all those things that we are not going to cover. But this is just a formula that we have to remember. In this, A is equal to future value. Future value means the value that is going to be in future. P is equal to present value, the today's value. E is equal to the, that E raised to the power we study now, that has a standard notation. So E is the exponential thing. So E actually is a constant only. So there is no need to specify this E, because constant will remain same. R is equal to percentage per annum. T is equal to time, which is 1 is equal to for 1 year. Again, so this E is the reverse of log that we have studied, correct? But this E tables, or the tables from which the E raised to the power value will be there, will be given in the question. So we need not worry how to calculate E raised to the power RT as a answer. Okay. So what we have to remember is that in case of continuous compounding, if the question says that it is continuously getting compounded, so we have to use the formula of P is equal A is equal to P into R, P into E raised to the power RT. RT is the rate and T is the time. So what we have to remember is, this is one formula in case of discrete compounding, and this is the formula in case of continuous compounding. So we were discussing on the compounding formulas. Yeah. Yes, Vivek. So we have studied that we have studied four cases, but broadly two formulas, correct? One is this formula, which I'm projecting on the screen. A is equal to P 1 plus R divided by N raised to the power T multiplied by N. That is the first formula. And the second formula was in case of continuous compounding, which is A is equal to P E raised to the power RT. The question will specifically be very clear how to use, when to use these things, correct? Namita is asking, sir, what is the difference between cash settlement? Namita, please complete the question again. Your part question has come. Okay, so let me go to the valuation principles now. Let us study the valuation principle. Now we know what is a forward contract, what is a future contract, what is a compounding principles, what are the utilities of forwards, futures, what is the difference between forwards and futures, and how are they traded on stock exchange, the futures I'm saying. Now let us come to the valuation piece. As we said that value is dependent on underlying, correct? But still, we have to value valuation of forwards and futures. Any one of them, the valuation principle remains same because the concept is same, correct? While purchasing a future, I am entering into a contract that I will purchase the equity share after the expiry, correct? This is what a future is. So we have a present value, which is a spot price, correct? Present value, which is operating in a spot price in the spot market, that is called as present value. From that, we have to calculate the future value. That's all. Very easy, very basic, no complexity in this process, in this formula. Very simply and very easily, if we have to calculate a price of a forward or future is equal to future value of spot price. Simple. What is the future value of spot price? That we'll have to calculate. Now in this, the expiry would be the time period, for calculating the future value. Simple. Because for calculating the future value, we need a time period, correct? So the time period is the expiry of the future. Now, we have already studied that there are two formulas. A is equal to, I'm just rewriting them here so that our entire loop is closed here. R divided by N, T multiplied by N. This is the basic formula. Then in case of continuous compounding, P E raised to the power RT. This is in case of continuous compounding. Correct? I'm mentioning here, this is discrete compounding. Discrete compounding means it's not happening on continuous basis. And here it is continuous compounding. I hope this is clear, students. Now, let's bring some complexity here. Okay. So, okay, first of all, student, I would like to clarify one more thing. See, this is today. Today is what? Again, 3rd December. As I told you that there is a future that is getting traded, correct? So today, there are two markets. One is spot market, which is the cash segment, and second one is the derivatives market. So in derivatives market, see the spot market, the price is being traded as 10 rupees, for example. In derivatives market, the future, let's say this is X Limited, future on X Limited, as I told, there will be 3 types of futures getting traded. 1 month expiry, 2 month expiry, and 3 month expiry. Correct? This is what I told. Now, 1 month expiry means that it is going to expire in December. 2 month means it is going to expire in January. It is going to expire in February. February 22, January 22, December 21. Okay. This is what it is, how it is going to expire. And all of them will have different prices. For example, it has 11, it has 12, it has 13. Now, what I'm trying to make here a point is, as the time increases, the value is also increasing, correct? That means the future value and the present value, there will be a higher gap between both of them if the time increases, correct? Because see, what is this 11 rupees actually? 11 rupees, rupees 11 is a future value of rupees 10 after 1 month from now. From today, after 1 month, 11 is the future value that is coming out to be for a security which is being traded at 10 rupees as on today. Correct? So both of these values are as on today. Again, 11 is also a value as on today that we are expecting after 1 month as per the formula. Okay. So this point, please keep in mind, because don't get confused that this 11 rupees is the actual value after 1 month expiry. No, this is just an estimated price as on today that we are expecting after 1 month from now. All these calculations are happening as on today. Okay. Now, as I was saying that in this formula, let us bring some complexity. Now, we have to see the treatments of two things. So students, if you see, there is a treatment of two things that we have to see. One is, in sometimes the question gives us treatment of dividend and transaction cost. Okay. Now, for example, the spot market, we have till now studied that A is equal to P 1 plus R divided by N, P multiplied by N. This is the basic formula, P multiplied by this, correct? But what if there is a dividend? There is a discrete dividend. Now see students, dividend is also of two types. One is discrete dividend, one is continuous dividend. Continuous dividend means that dividend which is continuously accruing to the share price, which is actually what happens in the real life. Real life, the dividend keeps on accruing every second, correct? And then there is a discrete dividend also. What is the discrete dividend means? Discrete dividend is 2 months from now, there is a 10 rupees dividend that will be paid, correct? That is called as discrete dividend. I'll just put here. So this is 0, 1 month, 2 month, 3 months. Okay. So what is happening is that we say that we are talking about a futures having a 3 month of expiry, correct? And we have a present value today. We have to calculate a future value, which is A. A is what we have to calculate, correct? But one more additional fact that is given to us is, after second month, there is a dividend of rupees 50 that we have to pay. That the shareholders are expecting a 50 rupees of dividend after second month. So that means this 50 rupees has to be adjusted in this price. So I'll just write the formula and then I'll explain it later. Present value of dividend, and it will be multiplied by 1 plus R divided by N raised to the power Tn. So students, now please note, first of all, this 50 rupees as a value, we will take it to the 0 day, which is today. We will discount this 50 rupees as on today. And whatever is the value as on today, we will reduce it from there and then take the future value of that after 3 months. Now, why we are reducing dividend? That question will come to all of you, because students, we are talking here about the valuation of futures. We are not talking here about valuation of shares. This we are not talking about. See, the dividend is paid on equity shares. Dividend will not be paid by any company on its shares futures. You're getting my point. If someone is trading in a futures of a equity share, will that entitle him to receive a dividend? No. The entitlement to receive a dividend is only and only with the actual equity shareholders who are there in the spot market. We are talking about a derivatives market here. In derivatives market, there is no dividend to be received by the traders of the futures. I hope I am able to make this point clear. Okay. Now, we have talked about discrete dividend here, correct? This is discrete dividend. Discrete means that it can happen as and when it is happening. For example, it is not happening continuously. It is happening discretely, 1 month, 2 months after some gap. Correct? That is called as discrete dividend. Now, in this only, let me also say that if there is a transaction cost that is involved, transaction cost we always add to the price of security. Okay, the transaction cost always need to be added to the security price, correct? If in the spot market also we pay any transaction cost, for example, we pay stamp duty, that will got added to the purchase price. So A is equal to P plus present value of transaction cost minus present value of dividend multiplied by 1 plus R divided by N raised to the power Tn. So this is the formula. So the transaction cost will get added, dividend will get reduced. Now Namita is asking why dividend of 50 will get reduced. Logic. Okay. So the logic here is that this 50 rupees of dividend, Namita, tell me one thing. We are talking about two markets, right? One is the spot market, one is the futures market. So if anyone holds a equity share in spot market, he will be entitled to receive the dividend, and hence it is okay to include in the value of equity share that 50 rupees, correct? But in case of a future, just by holding the future, is that person entitled for the dividend? No. This is just a future. Company will not pay dividend on future. Hence, we will have to reduce the value from the future. Hence, we are reducing the present value of dividend from here. So the future price will be current price plus transaction cost present value minus present value of dividend. Whole we will take for the compounding of 1 plus R divided by N raised to the power Tn. This is the case of discrete dividend. Also, I am writing another formula here. Okay, so this is what A is equal to P plus present value of transaction cost minus present value of dividend 1 plus R by N raised to the power Tn. This is first. Second is, if we talk about continuous compounding, this was for what? 1 plus R by N was for the discrete compounding, right? Now let us talk about continuous compounding. There also it will seem like this only. Present value of transaction cost minus present value of dividend, correct? Multiplied by E raised to the power RT. Simple. Correct? This is the second formula change. Similarly, the third formula change can be A is equal to P E raised to the power R minus Y T. Now I will explain this. Okay, this one is simple. It's derived from the above only. Even this one is okay. We have understood. Now, what is the notations here? Let us first try to see the notations. A is equal to future value P is equal to present value. E is again the constant that we have studied. R is equal to the percentage per annum return. Y is equal to percentage per annum on dividend. This is in case of a continuous dividend. See, till above, we have studied all discrete dividends. These are all discrete dividends. From here, we are studying continuous dividend. Okay, no, Namita, I am saying transaction cost is always added. If there is a transaction cost, it will always be added to the future value. Why? Because transaction cost we are always adding only, right? If it is pertaining to equity, it will be added to the equity price. If it is pertaining to futures, it will be added to the futures price, Namita. Okay, the question, while reading out through the question, this will get clarified. Now, this I was speaking on continuous dividend. Okay, above this, we have spoken on the discrete dividend. Now here, continuous dividend is only this element y is extra, which is percent per annum dividend, and t is again the time period. Now, students, please note that p is the present value, correct? In that, we will multiply e raised to the power r minus y. So r is a return by which the constant increase is happening. Y is the percentage where the constant decrease is happening, correct? Although there is a logic to it. See, we can rewrite this formula as PE raised to the power R T divided by E raised to the power YT. See, in this, what we are trying to do is the dividend we are trying to do the present value, because then only it will become PE raised to the power R minus YT. You're getting my point? Because if in the denominator we take it up, we will have to reduce it. I'm not going into the derivation again. What I'm trying to say is that this is also the present value of dividend that is happening by just doing this R minus Y. Very easy, very simple. Just remember this formula. Whenever there is a discrete dividend, then R minus Y will be the case. Jitendra is asking, who is introduced a derivative product like Tata Motor, Future Exchange, or company itself? No. So Jitendra, this derivatives concept in the market is well established concept which is used by the stock exchanges, as well as there is a proper legal regulation behind it. Okay, Jitendra. So it is introduced by the people who are there in the market only, because there is a need for these kind of products. Okay. So with this, we complete the valuation principles. Okay. We have to remember this formula, and this. These three are the formulas. That's all. See, this is the basic formula, discrete compounding, annual compounding. And if we introduce some dividend and transaction cost, then these are the three formulas that we will have to keep in mind. Correct. Very easy and very simple. Just keep simple logic in your mind. One is whether it is a discrete dividend or continuous dividend, that will depend the impact. And second is if it is a discrete compounding or annual compounding. Depending on that, we will use the formula. Okay. Now let us go to the question number 1 finally. Now we will try as many questions as possible to apply these all concepts. Sorry, one more point before we move there. This is the last point that I wanted to cover in the pricing. Price of future is equal to the spot price when, the question is when, can there be a situation that the price of future is equal to the spot price? That means the future value is equal to the present value. Can anyone attempt this question? What I'm asking. When will happen that future value is equal to present value? That means the price of a future is equal to the spot price, because present value is what? Spot price. Future value is what? Future price. With this, we will end the valuation concept and then we will go to the question. Please, students, respond as with your as many thoughts as possible. Right, wrong, don't care. Please respond. When will happen that the future value is equal to the present value? That means both the present value and future value comes out to be the same. Yes, very good. Jitendra is saying at expiry. Naveen Prakash is also saying on expiry. Very good. So on expiry, future price will be equal to the spot price. That means if you see, this is the spot price line, for example, correct? This is, let's say, 1 month, 2 months, and then 3 months, correct? We are talking about, let's say, 3 month expiry of a future. So the future will look like this. The valuation of future will be like this. This is the futures line, correct? So the futures line will coincide with the spot line on expiry. This is expiry, for example. Okay. And hence the gap between both of them will be lesser and lesser once it approaches the maturity. You're getting my point? Because the T is getting reduced in the formula. The T is getting reduced, this T. That will create an impact on the similar kind of a valuation. Okay. Now let's go to the question number 1. This is from the assignment only. It says that the 6 months forward price of a security. See, now it is saying 6 months. Now you have to analyze information very quickly. What it is given is expiry is 6 months. We're talking about a forward price of a security is 208.18. Okay. We are given a future price of 208.18. Borrowing rate is 8% per annum, payable with monthly rests. Now see the language. It says that payable with monthly rests. That means it is discrete compounding. Or I can say monthly compounding. What should be the spot price? Very easy, very simple question. A is equal to P 1 plus R raised to the power T divided by N multiplied by N. This is whatever basic formula is, correct? In case of discrete compounding, this is a discrete compounding because they are saying that it is payable on monthly rests. Now we have to fill the things here and answer it. Okay, sorry Naveen, I missed your query. So Naveen is asking, sir, how does continuous dividend work in practice? Shall we assume all dividends on equity is continuous? Very good question, Naveen. So Naveen, the thing is that practically, if you ask me, definitely the see what is dividend. Dividend accrues to a price of a security because of its performance, correct? And the prices in the market are true reflection of dividend adjusted prices. That's correct. So hence the continuous dividend, that means every second the dividend is also getting adjusted in the prices. Okay, Naveen. So continuous dividend is what substantially is operated in the practical life. Okay. So hence the continuous dividend will work in practice, definitely. But some informations, let's say insider information, let's say other things, will make the pricing a bit different with what the discrete, with what the continuous dividend will make. Okay, Naveen, that's a different thing. But if you ask me, dividend definitely will accrue every second to a security. Namita is asking, sir, is there any futures in BSE NSE that have maturity more than 3 months? No, Namita. More than 3 months, there is no future. Only 1 month, 2 months, 3 months is what I know. I would request all of you to check. In case you want to check, please do check. But as far as my knowledge is there, 1 month, 2 months, 3 months with a expiry on every last Thursday. So if you see the expiry date will be every last Thursday of that 1 month, 2 months, 3 months. Okay. Naveen is, yeah. So Naveen, I hope I responded to your query. Okay. So this is a discrete compounding, monthly compounding. We have used this formula. Now in this, we will just replace the numbers. So future value is already given 208.18, correct? Present value is what we have to calculate. Rate of return is given as 8%. What is n here? N is equal to 12. Because what was n in our formula? N is number of times the compounding is done in 1 year. Number of times compounding done in 1 year, correct? And T was 1 for 1 year. Here, what is the expiry? 6 months. So T is equal to 0.5 here, correct? Okay, Naveen. So Naveen is asking, thanks Jitendra for the answer. Your answer is correct. Naveen is asking in sum how to identify continuous or discrete. Now, Naveen, if you see in this, the way this question is drafted, it says monthly rest. So that means we will assume it to be discrete. Okay, Naveen? The question will tell you whether it is continuous or whether it is discrete. And one more thing, if in question the value is given as e raised to the power something is given to you, then always assume it is continuous only. Correct? Because this you will be able to utilize once you are assuming it is a continuous. Okay, Naveen. So we will go to the continuous questions also, but this is a discrete question. Now 8% divided by 12 raised to the power 0.5 multiplied by 12. Simple. T is equal to 0.5, n is equal to 12. If you solve this, you will get 208.18 is equal to P multiplied by 1.0409, correct? And P is equal to 208.18 divided by 1.0409, which is equal to 200. Jitendra, your answer is right. It's INR 200. Present value is INR 200. Perfect. This is the spot price. I say one more thing. This is a theoretical spot price. Okay. Because in theory, we are studying this is a theoretical spot price. And even if, let's say, we are given the spot price and we are calculating A, correct? In that case, also, A will be a theoretical futures price. Okay. This we will use in hedging and speculation, those two techniques. But I'm just telling you that it is just a theoretical spot price because it is coming out from a formula. I hope this is clear. Let's go to the next part. Now we have studied, okay, I have to tell you two more things. What is the different of position? See, one position is to buy, one is to sell. Very easy, very simple. What is new in this? But the buy position is also called as long position, and sell position is also called as short position. If in the question it is mentioned that someone wants to take a long position, that means he wants to buy. Someone wants to take a short position, that means he wants to sell. Simple. Don't get confused. Long position is all just buying the things. Short position is just selling the things. Okay. Then we also studied in cash market, also called as spot market. Here we are studied the derivatives market. Derivatives market. Both of them works in a different manner. Spot market, the actual delivery will happen, and this will be derivative market is without any actual delivery. This is just a net settlement that will happen here. Simple. Okay, that is what we have already studied. Also, students, from the practical point of view, also do remember one more thing. One future is separate from one contract. See, as I told you now, that the number of futures are how much. So for example, one future is one only, but one contract can have 1,000 futures. Correct? Because the lot size is 1,000. See, Yash is asking, is knowledge of prior topics necessary for doing this chapter? Yes, Yash. Otherwise, in the questions, we'll have to cover this. Otherwise, questions, we will not be able to interpret and do this. So hence, it is important to understand all these things, because one, questions are framed like this. Second is, we will not be able to solve the questions then. Correct? So if question mentions one contract, that means you should think that it is just a lot size that they have mentioned. It can be 1,000 futures, it can be 2,000 futures, it can be 3,000 futures. One future is one only. Okay. Now let us go to the main principle called as speculation and hedging. Speculation and hedging. These are the two terms. These are the uses of derivatives. We will see how. No, yes, as I said that definitely understanding is required. But if it is skipped, I would request you to go through the previous part of the session again and to understand these topics, because this will strengthen your overall understanding on derivatives. Correct? And will help you to have a logical reasoning behind a lot of things. Otherwise, I can just go to the question, solve it with a formula, that should be okay. But the purpose, the objective has to be cleared. Correct? And hence I am spending one today's session on the entire conceptual building. Then we will cover all the questions. Okay? It will be easy, very cakewalk. No, yes. What I request is, today only we started derivatives. So first you go through the prior part of derivatives first. If you don't have a basic understanding, if you have a basic understanding, you can continue from here. Okay. So speculation and hedging. Yes. So speculation is what? Speculation is, there are two things. What is speculate? If I'm sitting here and if I want to speculate, I will speculate that tomorrow the price is going up or tomorrow the price is going down. This is just a simple speculation that I have. So what it is hope of gain or risk of loss. Correct? I am hoping for a gain, or I am undertaking a risk for loss. Simple. Speculation, in speculation, you have only one exposure. You want to create one exposure. See, speculation is what it does. It means is you already have a piece of information. Using that piece of information, you want to gain. with the risk of loss. That's all. Hope to gain with the risk of loss. For example, now futures of X Limited, okay, you are taking a long position on that because you are currently having, yes, yes. No, no. Okay. Yes, you are saying see, only the derivatives is totally separate. You can start from the today's lecture only on derivatives is what I'm trying to say. Okay, Yash. The other topics are not there in this, is what I'm trying to say. This is independent to the other topics because I'm covering wherever it is relevant. Okay, so speculation, as I was saying, is let's say on futures of X Limited, someone is taking a long position because he has that information in his mind. He has that information in his mind that the price is going to go up. Correct. So with the hope of gain and the risk of loss, he takes a long position in futures of X Limited. So 80 is let's say the price and 1000 is what he purchases. So total 80,000 is what he purchases, the futures. Okay, students. So once he enters into a long position, do he need to pay anything to the stock exchange? Does he need to pay entire 80,000? No, because he's not getting delivery of the equity shares, right? He's just purchasing the futures. What does the future means? That he's entering into a contract that after the expiry, he will purchase the equity shares at 80 rupees. This is what the thing is. Yes, yes, it is not linked. Okay, so 80,000 is the futures part, correct? 80,000 is the total futures exposure that this person has created. Now, but stock exchange says that there is a margin. There is a margin requirement. Okay, stock exchange says that, okay, what if tomorrow the price goes down? You will lose and I will not be able to recover anything from you. So hence, stock exchange says that, okay, you keep a margin of 20% with me, which is 16,000 rupees. You keep a margin of 20% with me. That's the only initial amount that stock exchange takes from me. Now, tomorrow, what will happen? Tomorrow, I mean on expiry. This is on expiry. The futures can be, let's say, 70 or the futures can be 90. I'm taking a case of higher or a case of lower. Okay. So let's say it is 70 or it is 90. Simple. So in case it is 70, now I have taken a long position in futures. I have agreed to purchase at 80 rupees. Correct. But on expiry, if it becomes 70 rupees, I will definitely lose. Correct. Because I have taken a long position and if the price is going down, I will lose 10 rupees. That this is basis the settlement payoff that we have already studied in the previous session. Sorry, no, in the previous part of this session only, we have studied that. Correct. If the price goes down and you have taken a long position, because long position is that you have purchased the future. Purchase the future means you have entered into a contract to purchase the equity share afterwards. So on expiry, this is the spot price. Or you can say this is the future price also, correct? Because both of them will be same. So on expiry, if the spot price comes as 70 rupees, he will lose 10 rupees on 1000 futures. So totally he will lose minus 10,000, correct? And he has already given 16,000 to the stock exchange as the margin. So he will get back 6,000 only. That's all. 10,000 is a loss to him. Cash flow will be 6,000 on the expiry. That will come to him. Simple. If it is 90 rupees on expiry, then 10 rupees he will gain because he is already entered into a futures contract of 80 rupees, correct? So he will gain now in 2000. So this is again 10,000 he will gain. 16,000 is what he already have given. So stock exchange will return to him 26,000 rupees after the expiry. Okay. Why? Because here he will lose and here he will gain because he has taken a long position. Correct. And this margin, if let's say he has lost and initially they would have not taken the 16,000 rupees, then stock exchange will have to go and recover this 10,000 from them simply, which is not going to happen. Correct. If in case the person is not willing to pay, so there is a risk. Hence, they will accept a margin first. Now let us take a short position. Let's say instead of this long position, somebody takes a short position on futures. Can they take it? Yes. Short position is what? Selling it. So yes, basically these queries will be taken up by CA Ashish sir towards the end of the sessions once we have completed the course. So he will definitely take us through how to prepare for the exams, how to study for the exams, what all strategy we need to adopt. Correct. So that is definitely covered, but during the end part of the session, all the sessions once it is going over. Correct. So short position. I'm coming to the topic now. What is the short position on futures of X Limited? Let's say futures X Limited, somebody takes a short position at 80 into 1000. So 80,000 now. See, when will one take a long position? Once he has a speculation that the price is going to go up. Correct? If he has a speculation that the price is going to go down, then only he will take a short position. Correct? Because he wants to take the benefit from the short position. You're getting my point? Because he has an information which tells him that in future the price is going to go down, he will quickly take a short position and do the adjustments. So short position, he take 80,000. Now what will happen? So he will again give a deposit, a margin. Basically margin will be how much? 80,000 multiplied by 20%, which is 16,000. Correct. That is still required to be paid. Now what will happen on expiry? Again, I'm taking two cases. If it is 70, if it is 80, he speculated the price will go down. The price has actually gone down from 80 to 70. And since he has short sold, that means this 10 rupees will be a gain to him. Correct? Because he has short sold. He has what he has agreed by short position is that he will sell the equity shares of X Limited on expiry at 80 rupees. But actual price has turned out to be 70. That means 10 rupees he's still able to gain out of this contract. Correct? Because if in the open market he would have sold at 70 rupees, which is 10 rupees less realization. So because of this contract, he's able to realize 10 rupees more. That is what the gain is. And that is what the net payoff is. So which is 70 minus 10. So this will be plus 10,000 and plus 16,000 is what he has already given. So he will get back 26,000 from the stock exchange. Now, in case the price goes up to 80, now see what this guy will think is, okay, I have entered into a contract. Sorry, not 80. I have to put here as 90. Sorry. 80 is already the price. So I have sold a contract on futures, which says that I will sell X Limited. Short position on futures means I will sell X Limited equity share after the expiry, on expiry at 80 rupees. In the spot market, the price is 90 rupees. Don't you think 10 rupees I'm losing here? Because this contract has become an obligation to me, because in the open market, I would have easily gone and sold to 90, but now I'm only able to realize 80. So that means 90 minus 80 is a loss. So minus 10,000 plus 16,000 is the margin. So 6,000 net he will get. So this is what a speculation is. Correct. See, speculation is while taking the long position, if he speculates the price to go up and the prices have gone up, in that case, he's making a money. In case of a short position, if he speculates that the prices will go down and the prices actually goes down, then he makes some money. But if something reverse happens, then he will lose. This is what a speculation is. Simple. So this is the use of derivatives, because using derivatives you can speculate. You have piece of information using which you can act and you can speculate. Naveen is asking, so in speculation our cost of borrowing will be less because we are only paying margin money. Am I right? Yes, Naveen, bang on the point. Because in case of speculation, our only cost involved is the cost of margin. That's all. There is no 80,000 rupees that we are paying or receiving, right? The transaction is not happening on this 80,000. This is the reason why derivatives got introduced. With a less value of investment, you are exposed to the same level of risk, which is exposed in the equity market with a higher investment. So in the equity market, now you tell me you will invest 80,000 rupees. Your cash flow is 80,000 today. On 80,000, you are earning how much? Only 10,000. Correct? In case, let's say you are earning, you will be earning 10,000 only, right? So 10,000 and 80,000 will be how much? And 10,000 on 16,000 will be how much? Because in this case, you have only invested this margin 16,000. So you see the kind of exposure this brings in, because here you are investing 80,000. Here you are only putting 16,000. So if you will lose high. If you will gain, you will gain high. Okay, Naveen. So your observation is perfectly correct. In speculation, the cost of borrowing is very less because the funds involved are very less. Instead of 80,000, we are only involving 16,000. Now coming to hedging. Speculation is clear to all of you because speculation is very simple, very easy. Speculation just uses the information available to gain and with a risk of loss, because there is a risk of loss, right? And there is only one way, there is only one exposure. Now comes the hedging. I'm putting hedging here. Now, what is hedging? Hedging is protection actually. The second name of hedging is protection. Now, what happens in hedging? You are already exposed to a risk. You are already exposed to a risk. And you have to hedge against that risk. Hedge means protect against that risk. Again, I'm saying, see, in speculation, you have a piece of information which you are going to utilize with the hope of gain and with the risk of loss, correct? Because using that information, you will either take a short position or a long position. That's all. You will play the game, win, lose, game over. But hedging is actually a different is actually a different situation. Now, assume that you already, now what I said, you already are exposed to a risk. For example, you are holding an equity share already of X Limited. So Naveen is asking, don't we have to pay margin if we have holdings? Naveen, are you trying to say margin in case of spot market? Please clarify once. Because we did not consider this cost and margin before. See, Naveen, just elaborate your question. Are you asking that is margin there in spot market? Is that your question? I will then accordingly answer. So whatever is coming to the hedging is that you are already exposed to a risk. That means you are already holding an equity share of X Limited. Now, what is the risk that you are exposed to? If you are holding an investment in X Limited equity share, this is spot market, huh? Spot market. What is the risk that you are holding? What is the risk? Risk is risk that it might go down. This is the risk, correct? So risk that the price might go down. Once the price goes down, you will lose. For example, you have invested at 100 rupees. If it goes up, you will gain. There is nothing like it. But what is the risk? Risk is of it going down. So we have to hedge against the price going down. Correct? The hedging has to happen for the price going down. How can you protect yourself from the price going down? Can you make use of futures market? Yes, we can make use of futures market. See, one way is to protect yourself from the risk. Somebody might think, let's sell this equity share. We are holding an equity share. There is a risk of downside. We sell this, the risk is lost. But in case you do that, what is happening is you are not holding any investment then, correct? You are just purchasing and selling. That's all. That means there is no risk that you are exposed to. And hence there is no hedging that can happen, correct? So for hedging to happen, there has to be a risk. Then only you can hedge. So let's make use of futures market. Now, can anyone tell me in futures market, what should I do so that if price goes down, I gain in futures market and I lose in equity market and I'm protected? You're getting my point. I hope the situation is clear. See, here the risk is price going down. Now I have to devise a technique where I gain in case the price goes down. Correct. What is the risk? Risk is that price is going down. So hence I have to devise a technique in which if price goes down, I gain. I should gain. So how can we do that in futures market? I want responses from all of you now. In futures market, what shall we do so that any price reduction gives us gain? Shall we take a long position? Oh wow, Namita says short position. Very good. Before asking, very good, Namita. It's short position. So short position we should take in futures market, because if we take a short position, the futures market goes down, because see what will happen, the spot markets will go down. This is the risk. Since the spot market will go down, futures market will also go down. But since we have already taken a short position, we will gain in the futures market, we will lose in the spot market. The loss in the spot market is hedged against the gain in the futures market. Harshad is asking, sir, if in short, investor should get margin as he's selling. No, 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 no. Harshad, no. Again, okay, Harshad, I'll explain your query. So Naveen is asking, previously we considered only the cost of borrowing, the entire contract amount. Correct. Now we have the margin money and cost of it, that's right. But not considering both at the same time. Yes. I have not considered because that I have excluded. I just wanted to tell you that what is the return on base. So does it mean if we have entire shares in holding, we don't have to pay margin? Okay. See, if you have entire shares in holding, you don't have to pay margin. Simple. Correct. You don't have to pay margin. Because there is no risk that stock exchange is exposed to you. What will happen tomorrow? If tomorrow the price goes down, okay. So Naveen, I'm just answering your query. If tomorrow the price goes down, you're already holding the equity share. Stock exchange will give you lesser money. That's all. While you will sell the equity shares, stock exchange will give you lesser money. You will have to deliver the shares, and you can't ask to deliver the shares because you have already kept them in a demat format where you have already given them authorization to deduct. So they will automatically deduct from your holding those shares and will give you a lesser amount. So there is no risk that stock exchange is exposed to. Now Harshad is asking, actually Harshad, this question would be coming in a lot of students' mind. So it's good that you ask this question. Sir, if in short, investor should get margin? No, I'll tell you. Let me first take that query only. Okay. So what will happen? Here there is a person who has taken a long position. Here there is a person who has taken a short position. Harshad, I am answering your query. Please listen very carefully. Okay. So Harshad's query is, I am repeating Harshad's query. If in short position, the investor should get margin as he is selling, and while buying, he is required to pay the balance. That is what the query is. Okay. Now, what I'm saying is, here we are talking about the short position and long position from the point of view of derivatives, not from the point of view of equity shares. If we are talking from the point of view of equity shares, then the person doing the long position will pay the amount, and the person doing the short position will receive the amount because that is an equity. Actual sale purchase will happen. This is just a derivative. This is just a contract. What is derivative? Derivative is just a contract. Contract of what? Long position person will say contract to buy. Contract to buy on expiry. Here short position will mean contract to sell on expiry. Correct. They are not actually selling or buying the equity share. They are just contracting to buy or sell on a future date. That is what is derivative or this contract. Correct. He will buy, he will sell. Now, there is a chance that whatever price that they are agreeing to buy or sell, that means the futures price, they are also agreeing that today's futures price they will be agreeing to buy and sell, correct? But what if this futures price goes for a change? In both the cases, so there can, although okay, before this, although they are contracting to buy or sell, but they will never buy or sell. Okay, that is the beauty of this derivative. They are just contracting to buy or sell, but they will never buy or sell on expiry also. They will not do a settlement. They will not deliver the stocks. They will not receive the money. No, nothing is going to happen. They are just betting. They are just contracting to buy or sell. That's all. They will not actually buy or sell. But what they will say is after the expiry, as on the date of expiry, whatever is the difference, we will settle on basis that the person who is taking long position will also see that difference. The person who is taking short position will also see that difference. Simple. You're getting my point, Harshad. So they are actually not selling or buying. So hence the person who is taking short position will not get anything. He will rather have to pay the margin money because he is also exposed to a risk. He is exposed to a risk in case the price goes up. The short position person will be at risk because in case it goes up, the price goes up, he will be at loss. Similarly, the long position risk is he's exposed to a risk where the price goes down. Correct. So hence both of them have to pay margin, whether he's a short position or he's at long position. Okay, Harshad. I hope this point is clear. See, I'm just putting it here again. Long position is exposed to a risk of downside. What if the price goes down? The person who is having a long position in this contract will lose. I'm just talking about from the contract point of view. The person who is having a short position is exposed to a risk of upside. What if the price goes up tomorrow? he will lose. Correct? The entire short selling concept that I have taken all of you through is, it says the price has to go down, then only a short seller will be able to gain. Correct? You're getting my point. Harshad, please let me know if the query is clear or I need to explain it again. Okay, in some other way I will explain it. Otherwise, if it is clear to you, then we can move forward. So what I'm saying here is, short position also, since he's exposed to a risk of upside, hence the stock exchange will ask for a margin from him. Correct? And please, students, please make in your mind, they are not actually selling or buying the equity shares. They are just entering into a contract to buy or contract to sell. That's all. And the net settlement will happen basis that. Okay. Now coming back to the speculation. Yes. Speculation and hedging, sorry. So hedging, we said that for now, we continuing that example only. So share purchased. He has already purchased share at the rate 300 per share, for example. Okay. I'm going back to the hedging now. And since he has purchased the share, so he has to sell futures, correct? He has to short sell futures to hedge against the downside risk. See, in this, risk is downside. This is hedging the downward price, right? Okay, Harshad, what I request is you see the entire concept from beginning again, and then it will be properly stick to your mind. Okay, I can understand all of you would be getting a little confused, but don't lose confidence, because just stick to what I'm saying, correct? Because that are really the building blocks. So again, go through the session again. You will really find it now properly understanding. Okay, Harshad? Because I have tried to explain in a lot detail. So just go through the same thing again. Okay. And hence I'm saying, students, please listen to my words very carefully. Okay. Where I'm using risk, where I am using contract, all of them have a real deep meaning. Okay. So hence I'm saying, again, go back to the same revision and you will be able to understand, Harshad. Still in the next session, still Harshad, if you have some query, please do ask. Okay. So what I'm saying is, hedging, in case we have purchased shares in spot market, we have to sell futures in derivatives market to cover for a downward risk. Correct? Now let us see how it can happen. Now let's say you have sold futures at rupees 350 per share. Correct? Per one share. Now this is the initial transaction. Now let us say the closing price. I'm taking 3 examples here. Now let's say at the time of closing, it comes as 300. Can we see the initial payoff? I'm assuming again 1000 lot size here. Okay, for both shares and futures both. I'm assuming 1000 lot size. Okay, let's assume 100 only. Let's assume 100 only. Now what I'm saying is that initial payoff, while we have purchased these 300 shares, okay, in the equity market, in the spot market, we would have paid 30,000 on that. Correct? We have purchased basis 300 multiplied by 100, 30,000 we have paid. Okay, this is the initial payoff. Then you will also pay margin on short selling of futures, correct? On short selling of futures, because this is the initially you paid 30,000, and initially you will also pay on this 350 the margin. Let's assume margin to be 20%. So on 35,000 you will pay 20%, correct? Because I'm saying that 100 are equity shares and 100 are futures. Both of them are numbers are same. Okay. So you will pay how much? 7,000 here. 37,000 is your initial cash flow. Very good. Now this is the, let me put here as initial. Okay. And now this is the settlement price. See, at the time of settlement, if the closing price is 300, how much you will be able to realize by selling the actual equity shares that you have? 30,000, correct? Because the closing price, see, this closing price is on settlement. This 300 rupees is on settlement, correct? So sale proceeds from the actual equity shares. See, in this situation, students, I have included both spot market as well as derivative market. So transactions are happening in both. That is where the hedging is there, right? So sale proceeds you will get as 30,000, correct? 300 into 100, correct? Plus margin also you will get back 7,000. And what is the net settlement on this futures? You purchased it for how much? Settlement on futures. You short sold at 350. What is the closing price? 300. Closing spot price is 300. That means 50 rupees you have earned on 100 units. That means plus 5,000 you have earned. What is the total? 42,000. So investing 37,000, you are able to earn 42,000. This is case number 1. Now let us say closing price is 350. Okay, this is the second example. Harshad is saying, sir, means first all margin will stock exchange will collect, and then on expiry, winner will get his margin along with the money from loser investor will get only the right, Harshad. He may require to pay something more if situation is worse. That's right, Harshad. That's right. Okay, now your understanding is perfectly right. See, Harshad, now in this only I am doing that, what you are saying. Okay. So this 350 rupees, closing price is 350, right? Now you tell me initial payoff. Will there be a change in initial payoff? No. Initial payoff will still be 30,000 and this will be 7,000. 37,000 will be the amount that initially we are paying. Actually, initial payoff will not change in any of the closing situation that I'm taking, correct? Because initially it has already happened. Okay. Now coming to the settlement. Settlement sale proceeds, you will get how much? 350 multiplied by 100. You will get a sale proceeds of 35,000. Very good. You have purchased at 300. Your closing price is 350. You will get 35,000. How much margin you will get? You will get as of now the entire 7,000 margin because we are taking the settlement separately. So Harsha, just to correct now this understanding, and students, all of you, please listen very carefully. The settlement is actually adjusted from the margin only or added to the margin only. Okay. We will cover the initial margin and mark to market margin later. In that, it will cover very clearly. Okay. So 7,000 he will get for the margin, but on settlement, he has to pay something. No, because 350 is his contracted price of future. 350 is the closing price. No loss, no gain. Still, the amount is coming as 42,000. Wow. See, closing price 300 also, he is getting 42,000. Closing price 350 also, he is getting 42,000. Let's prove with a third case also. Take closing price as 400 now. One we have taken lower, one we have taken equal, one we have taken higher. Okay. Now the initial will remain same only. 30,000, 7,000, 37,000. Now we have a closing price of 400. 400 multiplied by 100 will be the sale proceeds because he is holding the amount. He's holding the equity share, 100 equity shares. He will sell at 400, 40,000 will be the value. Margin still will be 7,000, but the settlement will happen like this. 350 was the short selling on futures contracted price. Actually, it has moved up. Now, students, please tell me whether it is a gain or whether it is a loss on futures. Please don't disappoint me. Please mention right answers. Whether this short selling price going up from 350 to 400, is it a loss or is it a gain? Shall I say that 50 rupees is a loss or 50 rupees is a gain? The price has gone up. We have short sold as 350. Please respond. Okay, if wrong also please respond, but please respond so that at least I can correct the understanding. Very good, Namita, loss. Please respond, all other people, all other students. We have short sold 350. The price has gone up to 400. Is it a loss or is it a gain? Okay, let's think it logical again. We have short sold. Short sold a future means that we have entered into a contract to sell the equity share on an expiry date. If we have entered into a contract to sell the futures on an expiry date at 350 rupees, and if the open market rate on expiry turns out to be 400 rupees, that means 50 rupees we have incurred a loss, because in open market we would have easily sold at 400 rupees. Very good, Harshad, loss. Naveen, loss. Thank you. So that means it is a loss. Multiplying it by 100. So this comes as minus 5,000. Now, if we total this, it is again 42,000. Again, surprising. This is what the beauty of hedging is. This is what the hedging is. In any situation, in any situation, let it be whatever is the closing price. Your cash flow is 42,000. This is what you are hedged. The risk is hedged. You will invest 37,000, you will get 42,000 in all the situations, whatever is the price going to be. This is what hedging is. Now, can anyone tell me why it is happening? Obviously, it will happen because we have taken a other position in futures market. But I'm saying that why 42,000? Why not 40,000 in all the cases? This is a smart question now. Why not 40,000 in all the cases? Why 42,000? Because here we are earning 5,000, right? 42 minus 37. We are earning 5,000. My question is, in all the cases, why this is 42,000? Can anyone observe and tell me? This is the last question of the class, of today's class actually. See, I'll tell you what is happening here. If anyone can attempt, right, wrong, no matter. My question is that why in all the three cases we are getting 42,000? We are getting same, that is true, because of hedging. But why are we only getting 42? Why are we not getting 46 or 40? This difference of 5,000 is actually, if you see, shall I start? Or is someone responding? Okay, Naveen is saying inverse relationship, the price between buy and sell. Namita is saying because we hedged all 100 equity shares. Okay, Namita, so the quantity is okay. We definitely hedged 100 equity shares. But Naveen, I think you are right to the point, somewhere close to the point. See, you see, we have purchased an equity share, buy equity share at what price? 300 rupees. We have sell futures at 350 rupees. This is our initial transaction. What is the difference that we are locking here? 50 rupees. See, buy equity share means currently we have a holding at 300 rupees. Sell future means I am entering into a contract to sell at 350 on expiry. That means if I am already having a contract to sell at 350 on expiry, and that product I am already holding at a cost of 300, don't you think I have already booked my profit of 50 rupees per equity share on 100, which is equal to 5,000 rupees. This 5,000 is nothing but this gap. Okay. So the hedging is clear now. Hedging is clear. Hedging, what we do is we already are exposed to one risk. Very interesting. Exposed to one risk, and we try to hedge against that risk. Okay. This is what broadly is. And now in the next session, we will cover a lot of questions. We will cover certain one or two more concepts, and we will wrap up the entire forwards and futures by covering a lot of questions in the next class. Okay. I hope we are able to understand the difference between speculation and hedging. Okay. Speculation is that I have only one position. Correct. I am speculating the price to go up or to go down. Basis that I am playing in the prices. But hedging is I want to protect my one of the risk that I'm already exposed to. That is what is hedging. Hedging is protection simply. Okay. Now, in this case, we have done the hedging of X Limited with X Limited's future. Correct. Can we do X Limited hedging with index futures? Yes. Why? X Limited is related to an index. Index is, let's say, BSE, NSE with beta. Correct. This we will study in the next session. As of now, I'm just leaving this thought to all of you that hedging is a very vast principle. It's a very vast subject. Correct. So what I'm trying to say is that the strategy we will have to just simply remember taking the opposite position in the other market. If it is cash, we have taken long position, we have to take short position. In cash market, if it is a short position, then we have to take a long position. So students, with this, I hope you enjoyed the today's all the topics that we have covered. But please do revise all these concepts before coming to the next session, because these are the very, again, I'm saying very building blocks for the entire derivatives topics. And if you have any queries, please do let me know. Anita Gupta is saying because of margin on spot price. Okay, so maybe Anita, you would be referring to this 350 minus this explanation that I have given. So yes, this one basically. This is the reason, Anita, that because of the gain. Okay, margin on spot price is not there. Margin on futures is there. And this is the difference between the futures price and the spot price. Okay. With this, let us end today's session. Please do revise well, and let's connect back in the next session and cover the other topics. Thank you so much. Stay safe.